So I sort of saw...
And you're closer to 20, right?
Absolutely.
Yes, absolutely.
That's why we have you here. So I did see a theme on the debt side. There was a lot of GSE debt. Now I'm wondering if there's any risk there, because there's this endless concern about what's happening with the government and the reform of Fannie and Freddie.
Right. Now,
Better yielding,
there
though,
is some.
obviously.
It's you know, we try to bounce. We actually go a little bit deeper into the corporate debt than people that have a more traditional ag type portfolio. So we try to mitigate that some, and we constantly rebalance. So if you look at the way we build our long fixed income piece, it's 4 pieces equally weighted monthly rebalance. So it's governments, corporates, mortgages, and that unhedged foreign bond piece. And then we also use cash. So we try to mitigate any kind of momentum risk that might be inherent in any of those 4 or 5 asset classes by trying to constantly rebalance in a very disciplined way every single month. So absolutely any one of those asset classes for us, really, to be honest with you, it's been the foreign bond exposure has been a lot more risky to us.
Because of what happened in emerging markets.
And because of the currency changes. You know, the yen has really had a big impact on our foreign fixed income. But do we believe fundamentally that all of those asset classes are still worthy of meaningful investment? Absolutely, but you've got to be disciplined in the way you get your exposure to all of those and constantly trim your winnings, reinvest in weakness, and keep a very disciplined approach to the way you diversify. So absolutely, all those asset classes that we invest in, all 14 of them can have risk at certain times, but as long as you kind of maintain your exposure and keep control over what you're doing, you're going to be in much better shape.
Anytime we talk about retirement, it's very difficult because people know that they're supposed to become conservative, but most people head into retirement and they don't have enough saved. Generally speaking, what advice would you give to people in terms of that ideal equity fixed income balance? Should people be more aggressive even when they see what the stock market's done? Because we know people a lot of times remain underinvested through a bull market.
Right. Yeah, you know, you've got to be careful with that, Ron, because it's you know, what we've always seen, even in target date funds. If you look at the 2010 funds back in 2007 through kind of 2010, really through the present, you saw a lot of that panic where people, you know, I think the flows went from maybe positive 800 million a month to minus, you know, 700 million a month at absolutely the wrong time, where people panic at the bottom and they really didn't start buying into those 2010 funds again until after most of the recovery already happened. So you've got to be careful not to let the market's moves really dictate what your asset allocation is, but really let your risk tolerance dictate what that is, whether you be an individual investor or a planned fiduciary that's making a decision on behalf of a wide body of participants.